Hey everyone, and welcome to This Explainer. I am absolutely thrilled to guide you through today's topic, structuring your social impact. Now, look, if you're a social entrepreneur, you've already got the passion, right? You have the drive and the vision to actually change things. But here's the hurdle literally almost every visionary hits: choosing the right legal engine to power that vision. Navigating the legal structures of social entrepreneurship in India can honestly feel a bit like wandering through a maze blindfolded. So today, we're going to demystify the whole process. We're breaking down the exact structural trade-offs you need to understand so you can protect your mission and your legacy. So, let me ask you a question that stops a lot of founders right in their tracks. If you want to solve a massive societal problem, does that mean you absolutely must give up earning profits? For the longest time, the traditional thinking was just the strict binary. You were either a ruthless capitalist making money, or you were a selfless philanthropist surviving on a shoestring budget. But under the law, is that actually true? Well, let's dive right into this. Social entrepreneurship is fundamentally a business attempt to solve a specific societal problem. And the absolute key takeaway here is actually the second half of that definition. It may or may not be a nonprofit organization. You absolutely need a formal legal engine to solve a social problem, but that doesn't strictly mean you have to form a nonprofit. The defining factor isn't whether your balance sheet shows a profit. It's whether the primary objective of your whole operation is to solve that specific issue. This really illustrates the full spectrum of legal possibilities you've got at your disposal. On one side, you have for-profit social enterprises. A great example of this is small finance banks. These are straight-up for-profit entities, but they focus on making funding available for micro, small, and medium enterprises. They serve a sector that famously faces major funding difficulties, so they further a social cause whilst still turning a profit. On the flip side, we have nonprofit NGOs. Think of citizen-run civil rights organizations like the People's Union for Civil Liberties or the Association for Democratic Reforms. These are set up purely for a social cause, without any government affiliation. You basically have to choose where you want to sit on this spectrum. Okay, so here's our roadmap for this explainer. We'll start with the setup, then meet the contenders. After that, we'll dive into the battle for control, keeping your seat at the table, dealing with the red tape, and finally, making the final decision. Let's jump right into part one, the setup. Choosing the right engine for your vision. Moving on to part two, let's meet the contenders. We're going to look at the three most common nonprofit structures in India. These are the Section 8 company, the public trust, and the society. Now, here is a really crucial piece of info to keep in your back pocket as we compare these. They all enjoy very similar tax benefits. From a pure taxation standpoint, one isn't massively better than the other. However, their governance structures, meaning how decisions are actually made, who holds the real power, and how they operate day to day, are entirely different. Which brings us to part three, the battle for control. This is all about ironclad authority versus democratic participation. Let's map out your operational future here. With a trust structure, the trustees absolutely rule. In fact, a trust deed can vest all effective decision-making power in just a single person, like a managing trustee. This gives a founder ironclad control. Next up, look at the society. Who rules here? The governing body and the members. A society requires a minimum of 7 members, and by its very nature, it is highly democratic. Members have to participate in decision-making, which means your control as a single founder gets significantly diluted. Finally, we have the Section 8 company. Here, the board of directors and shareholders rule. It operates basically just like a normal corporate entity, which gives you incredible management flexibility. You can even issue new shares to donors or employees to give them a stake in the whole shebang, without necessarily giving up your ultimate control. Let's look at part 4, keeping your seat at the table. We'll cover the legal clauses you can use to retain your founder influence. Now, what if you choose a more democratic structure, but then you worry about being pushed out of your own organization? Honestly, it's a very real fear. But even if you opt for a society, which we know is highly democratic, you aren't completely powerless. As a founder, you can literally embed specific clauses right into your constitutional documents. You can write in that you hold a lifelong post on the managing committee. You can legally grant yourself veto powers in the decision-making process. And if you go the Section 8 route, keeping your seat at the table is as straightforward as just retaining majority shares. That guarantees you ultimate control over appointing or firing the board of directors. But wait, before you go locking down all the power, consider this major trade-off. Exercising lesser control might actually be way better for your long-term vision. Why? Well, because if your nonprofit plans to set up further institutions down the line, like schools or colleges,
Heavy, centralized control can actually stifle that institutional scaling. And this is exactly why educational societies heavily prefer the trust or society routes. Sometimes, to grow your impact, you actually have to democratize your power.
Moving right along to part 5, the red tape. Time to navigate compliance, audits, and setups. Okay, so setting up the structure is one thing, but running it legally is a whole other beast. Let's see how this translates into the actual setup process for a Section 8 company. It used to be incredibly complex. You needed separate licenses and everything, but thankfully it's been beautifully streamlined. Step 1 is the RUN system. That stands for Reserve Unique Name. You pay a fee and you lock in your organization's name for about 40 to 60 days. Step 2 is the Spice Plus form. This is basically the master document where you submit your memorandum, your articles of association, and crucially, an estimate of your future annual income and expenditure for the next 3 years. If your paperwork is all in order, the registrar grants your certificate.
So, the crucial point here is that ignoring the red tape has very real financial consequences. A flat 10,000 rupees. That is the fine you can be slapped with if you form a public trust in the state of Maharashtra and fail to register it with the charity commissioner within 3 short months of its creation. The government definitely does not accept, "Oh, I forgot the paperwork," as a valid excuse. And remember, public trusts in India are generally irrevocable. Once you set it up and transfer property into it, you can't just easily undo it.
And honestly, the work doesn't end at setup. Transparency is legally enforced across the board, but the flavor of the red tape definitely varies. If you form a trust, you face strict annual filings and audits with the local charity commissioner. If you choose a Section 8 company, you've got to follow rigorous high-level corporate filings with the Registrar of Companies. But societies? Oh, they face a really unique mountain of localized, constant reporting. Democratic participation comes with heavy mandatory rules. You absolutely must maintain meticulous books of accounts. You must conduct formal audits of those accounts. You have to file financial statements and audit reports with the Registrar of Societies. And on top of all that, you have to constantly maintain and annually file an updated list of your members and your governing body. It's a whole lot of paperwork just to keep democracy running smoothly. Let's wrap things up with part 6, the final decision. Time to synthesize all these structural trade-offs. We've covered the definitions, the control mechanisms, the legal loopholes, and of course, the compliance burdens. So here is your master summary to help you decide which engine is going to drive your organization forward. If your absolute priority is maximum individual control over decision-making and economic matters, you choose a trust. If your goal is to build a community-driven organization that thrives on democratic participation from its members, then you choose a society. And if you want scalable corporate flexibility, where you can issue shares to donors, maintain board-level control, and operate just like a modern company while serving a charitable cause, you choose the Section 8 company. Which leaves us with this final thought for you to ponder. Control or democracy? Which will build your legacy? Look, there is no one-size-fits-all right answer here. Your legal structure absolutely must reflect your personal philosophy as a founder. Do you need a tight grip to ensure your vision isn't diluted over time? Or do you need a democratic foundation to scale a massive movement? The choice you make today will define the impact you have tomorrow. Thanks so much for joining me on this explainer, and I really hope this helps you structure your social impact with absolute clarity.